Hello, everybody. Welcome to another Allsop podcast. Today we're focusing on Central London investment. My name's Ed Dunningham, a partner in the valuation team. And with me, I've got Nick Pemberton from our West End team.
Hello.
And Chris Room from our City team.
Morning, Ed.
So without further ado, perhaps, Nick, do you want to start off with
Thanks,
your
Ed.
thoughts on last year?
2024, Central London finished around 6 billion, which is historically pretty low. The West End was actually a larger half than the City, so West End did 3.75 billion. In context, the 5-year average for Central London is about 11.5 billion. So Central London commercial, 11.5 billion. So last year was 6. You know, if you actually compare that to the peak I think was 2018, where we saw 20 billion. So, you know, peak market 20 billion, of which 12.5 was in the City.
Yeah, it was a big year.
Yeah, and you know, this year so 6. So in context, it's kind of running at half the 5-year average, and a third, if that, of the peak. But I think it's interesting to note that certainly in the West End, the transactions volume is the larger lot sizes that are kind of absent. The actual last year was 106 deals in the West End, which actually it's only been twice in the last 5 years. It's been that level of volume. So people are still doing deals, but the total volume is significantly reduced by the lack of sort of big deals.
Yeah, I mean, we had the lowest annual volume since 1990 last year.
Wow.
So 2024 was a very low volume year, 2.26 billion, as you say, a lot lower than the West End. The 5-year average in the City is around 6 billion. So I guess in line with the total for Central London last year. And yeah, as you say, Nick, I mean, we had only 4 deals over 100 million in 2024. In 2017, by context, there were over 35 deals over 100 million, and a further 10 between 90 and 100 million. So, you know, the average lot size is dramatically smaller. We worked out about 31 million last year versus, again, over 90 in 2017. And I think, you know, that's very reflective of the transactional volume, really. Yeah. But still, over 80 deals. So, you know, there's a number of transactions actually happening, which we can be buoyed by. And Q4 was certainly stronger than Q1 and 2 last year in the City, but a very low volume year.
It's almost a record low, isn't it? I mean, why is that? Is it just because the people are waiting and watching, or is there just uncertainty just keeps ticking on?
I think post-pandemic, people fell out of love with offices. And if you looked at if you look at 2023 and the first half of 24, the bigger deals were Bond Street shops or a couple of life science type deals. There were very few sort of office-led deals. So, you know, bearing in mind offices make up a large proportion of the Central London volume, people just did not want large office deals. You know, you had the Blackstones of the world a couple of years ago, 2-3 years ago, saying, you know, we're not buying offices globally at the moment. And that sort of sent a bit of a signal, not just for London, but I think London's been one of the first to return, you know, if not full-time, 4 days a week, certainly to the office. And the second half of last year, we really started to see people putting offices on the market again, and 100 mil plus lot sizes starting to trade again. 100 New Oxford Street is a great example of that. It was put on the market at 140 million, 5.5%, I think, sort of in Q3 last year, and they did 50 viewings, had 10 bids, put it under offer to JP Morgan, and it was in the press recently that actually the vendors have decided to hold. The main reason being owned by a German fund. And the German fund has started to experience inflows, so said, you know, we don't need the money anymore. But what's interesting about that is 50 viewings on a 140 mil office building, you know, Tottenham Court Road sort of junction. It's a really positive sign for the market, and that's continued with other sort of big office sales.
Yeah, and I think, you know, a lack of buyers in that 100 million plus category, I think that's what we've really lacked in the market. I mean, the City's been a little different in that, you know, there's been a lot of money chasing hotels, serviced apartments, student co-living. That whole side of thing has buoyed probably 35 to 40% of that volume. So going back to Nick's point, offices being out of favour, we've actually had probably quite a good year considering, because of the money that's been there for the change of use plays. So it's sort of actually compounded the impact a little bit, but it is definitely coming back, I think.
It does feel like the money's there, but of course, one interesting thing to look at is the interest rate environment. And of course, the base rate has come back over the last 12 months by 50 basis points. And but the reality, the long-term rates are SONIA swaps. So just looking at it today, March 24, 3.94%, and March 25, the same sort of level. So those longer-term rates are still looking quite expensive. And of course, I suppose a lot of the market is waiting for that rate to drop. The cost of borrowing, that sort of green light, it hasn't properly turned green yet. It's kind of flicking on amber, I suppose.
Well, certainly for the larger lot sizes, everyone is driven by debt. And I think, we've always hung our hat on, the Asian market coming into London and buying these buildings, these end of business plan buildings. And, they've always got an eye on domestic debt in the UK and the costs. And as you rightly say, it hasn't really shifted that much. I think there's definitely more positive sentiment, but I still think that the cost of borrowing isn't quite there to achieve the yield. Certainly not in the city, or it hasn't been in the city. I think that's starting to change.
So yields are stable at the moment in terms of City and West End.
I think West End, they've kind of almost remained stable throughout the whole. Post-pandemic, yields haven't really moved very much. I mean, I know mentioned 100 New Oxford Street at sort of 5.5%, but then you're getting, we're getting some sub 4% and 4% deals where there's quite a bit of rental growth to come. And almost in the West End, when you've got sort of value add product, because rents are moving so quickly, 14 St George was sub 4%, but off kind of low 100 rents where they're predicting they could get to later 100 rents. So, that's a massive growth in rents. So the yield is almost kind of less important. But yeah, I mean, so in the West End, in the core, it's about looking at your business plan and projecting where you think your rents are going to be, and that's what's driving value more than anything. Whereas I think the city was probably slower, but it's now catching up. I think my sense is the city's sort of 6 months behind the West End, and it's all coming.
I think you're right, Nick. I think we've started to see evidence of a little bit of yield compression, and there's a couple of deals at the moment. We're hearing Capital House being bought by a partial owner occupier, which I'm hearing the yield will be sub 5% on that, which, given what we've seen in the city in terms of evidence in 2024, we only really saw a couple of deals around the 5% mark, Wombo Churchyard being the main barometer, really, 12 years to Shoesmiths with some fixed uplifts, which skewed it slightly, but a freehold between Bank and St Paul's, 50-60 million pounds, and that was just over 5%. But aside from that, there's not been a huge amount of core rack rented evidence that we can hang our hats on. So King William Street will be interesting, but I think you're right, buoyed by rents. The occupational market is very, very strong, has been in the West End certainly for a while. The city is now seems to be catching up. We've seen some really, really strong rents, and I think that is there's a combination of yield and capital value, and we're going to see some very, very strong capital values on some of these transactions in the city, I think.
Yeah, I think the yield gap between the West End and the city probably is as wider than it should be, would be my... I mean, I'm a West End agent, so I'm not going to plug the city too much, but yeah, it does feel like the city is sort of catching up.
I think so.
There's clearly the rental growth that's happening and expected to happen is driving activity, and it's just starting to now sort of pick up a little bit. And what are expectations for rents in the city and West End at the moment over the next year or so?
I think you sort of, in some ways, pick a building, and in other ways, pick the top half versus the bottom half sometimes as well. And we're seeing some, reported rents starting with £200 a foot plus on bigger floor plates on the best of the best kind of thing. The Phoenix deal, so roughly 100,000 square feet, US law firm, that's reportedly sort of in the press at sort of 175 overall. So that's kind of 200 on the best space for big chunks of space. So we are really seeing in the core some of these rents really moving, and people are worried about space, and people are worried about securing their next office. There's definitely a flight to quality and a flight to core locations in some people's mindsets. So we've got a limited supply pipeline. The supply pipeline in our market in the West End is kind of probably lower than it has been in terms of grade A not already committed. 40% of the new grade A space, I think, is already committed.
I mean, it's exactly the same in the city. And I think, we've seen, we're talking about rental growth of probably 11-12% last year, and then forecasts are 20% over the next 5 years. And actually, I can see that being superseded on best in class, because there are now tenants taking pre-lets 3, 4, 5 years ahead of actually having, the Mishkon's rumoured on Holborn Viaduct. And, that will be, a number of years till they have a lease expiry and then a building that's still occupied where they're pre-agreeing a rent of £100 per square foot plus, and I think things like that are very interesting. The towers, there's very little space left. Last space in one Leadenhall apparently has gone under offer at 145 quid a foot.
Wow.
Which
that's presumably high up, is it? Or...
I'm not sure what level actually, but I presume it's an upper level. But I guess the point being that, the towers will then be full. There's very little space left, and there's already talk of pre-lets on 50 Fenchurch, which is still a hole in the ground. And I think this is what's driving it. And we will have a very different rental growth forecast for towers and prime grade A versus A- stock, I would have thought. But it's going to filter down, and that's certainly driving a lot of appetite for offices. I think.
And I suppose the other thing that's sort of keeping the market in check, if you'd like to call it that, is the cost of developing, refurbing, and so on. Some of these developments are starting to happen now because the rental growth makes it viable.
Makes it viable, yeah.
But
exactly.
what sort of levels are we talking to what's the sort of hurdle that you've got to get past to get a building out of the ground in the city?
I mean, we were talking about debate on type of building and site and what are the costs, but I think, you need to be probably 85, 90 quid a foot, I think, to try and, boost above to justify doing the development. I mean, I think costs, the dramatic inflation in costs seems to have slowed quite a bit, but we've still got inflation. So, I can't see the costs coming off.
Yeah.
It's certainly not in the short term.
The kind of tower feels like £100 a foot. If you're not hitting those rents, then it just sort of doesn't stack up really. So
yeah, correct.
And I think in the West End you've got further constraints just by the kind of geography and the listed buildings and the how long it takes for schemes to come forward.
There's more optimism, though, I think, for people to push the button on schemes now, given the rental market. I think if there's a time to go and push the button on your tower consent, and we know there's a few out there, it's not a bad time. It's getting the funding and the commitment to do that, which I think has proved difficult over the last few years.
And obviously in the city particularly, we've seen a lot of change of use coming through, hotel, C1, that type of direction for some of these conversions. Is that forecast to continue? Do you think that will keep going? The hotel market is hot. Yeah,
absolutely. I mean, I think the city haven't really tightened up their policy yet, or their planning policy on the conversions. And I think if a building configures correctly, if it's a building that's perhaps no longer viable for office use, there's a very stringent viability test that you have to go through at the moment with the city, certainly on buildings that perhaps are in core office locations. But the thing with C1 is the occupier appetite is there. So, your Whitbreads, your Stay Cities, your Motel Ones, they've all got big quotas, room quotas to fill this year. And, they will be, the city is a key target because the planning policy is quite favourable. So at the moment, that's continuing. If you have a building with that change of use potential, with vacancy, the pricing, VP values for a C1 apart hotel use, or even co-living use, which seems to be, what some people are going for, tends to be higher than the office use.
Although it does feel like the office alternative is starting to fight back a bit now.
I think so. I think in the right locations, if you can realise those top rents, definitely, yeah, I think so.
So what share of deals last year were kind of resident office to resi, and what were sort of traditional office? Yeah,
around 35 to 40%.
Okay.
But I would say not traditional resi, but that would be student, service department, hotel, or co-living in the city. Yes, so a big proportion of that 2.2 billion.
One feature of the market at the moment with rising office rents and relatively, in historic terms, soft yields, are the return of the owner-occupiers to the market, and some of those deals happening. What's your take on that?
Well, there's been quite a lot in the city, and I think it's the business case for a tenant, I guess, or an occupier to go and buy a building at the moment is quite strong because the rents are very high. If they've got a lease on a building and perhaps a rent review coming up or lease expiry, then they're staring down the barrel of some huge potential rental increases, and the investment market's at a relative low where VP values have come off quite a lot. So the business case is very strong. I mean, we've seen some good examples recently. I mentioned Capital House before, which is a partial owner occupier taking, I think, the fourth floor, and then they'll take on the investment. State Street's probably the biggest one that's been in the press recently, which would be a move from Canary Wharf into the city. We've seen other tenants do this as well, HSBC, for example, and they're rumoured to be forward purchasing Helical Bars 100 New Bridge Street. And the pricing on that we hear is over 300 million, which will be 1,700 a foot, which will be a real landmark statement and purchase. So, and then on the smaller level as well, Ed, we've seen a few deals. Asia House on Lime Street, private Turkish bank. We advised a charity on a purchase moving from Balham into Farringdon, and again, they're able to get hold of buildings for much lower capital values per square foot than historically, and then they don't have a rental liability. So I think it's a very interesting time for owner occupiers at the moment.
That is quite interesting because it's matched in the West End. I mean, we've had, probably the record cap value foot paid for an office building paid by a fund of a building on Grafton Street just off Berkeley Square. That was 100 million, well into the threes per £3,500 a foot. We had 3 St James's Square bought by Realty Corp. That was, I think, 125 or mid 120s lot size. And then 11 to 12 St James's Square, we had Larry Ellison of Oracle fame putting some of his family office into that. So that was bought pretty much with VP. So yeah, it's exactly the same in the West End. And I think, and then we've also have sold a couple of buildings again to owner occupiers. We sold a beautiful building in Bayswater. We had I think Q3 a bidding war between several different owner occupiers. 2 of which lived in Holland Park and wanted to be able to walk to their office, and that was sort of 30-ish mil lot size. So that continues in the West End, and of course the other piece of it in the West End is the retailers buying their own buildings on Bond Street. I mean, the second biggest deal so far this quarter was Prada buying Miu Miu's building for 250 million. We've also seen LVMH buying for the Dior store, Richemont buying Boodles, and then sort of back in 2020 we had Chanel buying their own store as well. So that probably adds up to £1 billion worth of Bond Street with and I think I did read somewhere, this might be wrong, but I think a third of sort of the core Bond Street shops now are owned by the retailers themselves. So this whole idea of protecting your rent is one thing, but I think the difference with just sort of thinking about the difference with retail is it's more operational real estate. But what's happening with offices is, in order to convince people to come back to work, business owners are seeing their offices as part of their operational real estate now. It's part of their purpose. So the reason for people buying their own buildings is to create that sort of collegiate environment, whether it's the race for the best quality space or better locations or improved buildings. You can see why people are owning your own buildings so that they can, it's part of their
more
DNA,
control, isn't it, as well?
Yeah.
More control over their own. Yeah.
So it's a really interesting feature at the moment.
It's fascinating, the Bond Street issue, because some of those prices are eye-watering, but it as you say, it's control over the estate, control over the future occupation,
control over your rent as well.
And the rent.
That's the
having
thing,
the freehold is the way to go.
Yeah.
It's the business case, isn't it? The rent. Yeah.
So what about the buyers? Who are the buyers in the market at the moment? We've talked about owner-occupiers.
So the city, I mean, we've had sort of liquidity, buyer pool liquidity has been a bit lower last year given the lower volumes, but certainly changing. I think with a lot of European money coming back into the market, we saw the French funds coming in last year, they're driven by yield, wanting 7% plus ideally. I think that, they're going to start being outbid, I think, by more of the private Europeans. The German money is starting to come back into our market as well. DWS, well publicised, they're trying to buy 70 Chancery Lane, which is, a long let building on in a core midtown location. We're hearing similar things about Union, Decker bought a hotel, I think probably over in your patch, Nick, last year. So, and I think when the Germans start coming back into the market, having inflows, that's going to drive pricing forward a little bit. So there's European money, there's quite a lot of Israeli money still looking and, keen to get a foothold, and, they are quite aggressive at the moment. They are yield driven. I think the UK funds as well starting to realise they're quite underweight in offices. I think probably more so looking at the West End first, Nick, but may turn to the city as they get potentially outpriced in terms of yields.
Yeah, it's really interesting you say about the funds. We had Legal and General buying a building off Aviva in Golden Square. We've got quite a lot of UK fund requirements. That sweet spot, sort of 20 to 80 million, where where you can hopefully capture some of the rental growth. I think that there's such a broad investor base now in central London, in particular in the West End, we've got the US early movers with kind of the US private equity houses, Ares and Elliott, for example. And now we're starting to see a building, Aware Super, Australian superannuation schemes. They're buying a building in Manchester Square with Delancey. There's just a real broad demand. There's again, like Chris says, a lot of Europeans, a lot of Israeli money for the smaller lot sizes. And again, so bidders on 100 New Oxford Street, and other buildings like Manchester Square, you did have some of the more traditional, the older names like Decker, bidding on things like that, and then a lot of high net worth families.
Point you mentioned on American PE as well. Blackstone making a pretty bold statement, very well publicised. They're now looking at the kind of ham again at increasing the price, and that could take the yield down a bit. And I think we'll see that American money's not slowing down, is it? I don't think.
Yeah, in some ways, Blackstone sort of saying a couple of years ago we're not keen on offices, kind of helped this kind of slow down in demand for offices, and them signalling that they're back kind of is almost not quite a starting gun, but it might be for the city.
It's interesting, isn't it? And of course, the other dynamic that we haven't mentioned is obviously the equity markets are a bit wobbly at the moment. The Trump tariffs are scaring the markets, and does that impact on real estate? Does that make us look more attractive, do you think?
I think it's more of a question for you, Ed. Evaluations.
It's hard to say, isn't it? But you would have thought, if the share markets are coming back, then does that put the ball in the opportunity for real estate? I mean, I think from our perspective, and on the valuation side, we're doing an awful lot of loan security work, and for the last year or so, we've seen most of the work we've been doing are loan reviews. The banks checking up on their existing loan books, checking on numbers, reviewing. But we've reached this pivot point where we're still doing some of that, but there's a lot more new lending going on.
Okay.
And I think that the new lending element of what we're doing is now taking over from the reviews. So
that's good.
The banks are really keen to do business.
We're near the end of the first quarter, just kind of cantering through where we are. And I think the city and the West End at the moment seem to be a bit kind of neck and neck. We're tracking with 2 weeks to go. I think 14 deals done in Q1, £950 million worth. And then, but equally with about another billion, close to £1 billion under offer. I think a lot of that with 2 weeks to go probably won't happen. But there's some interesting things under offer. You've got Norge buying a big chunk of the Grosvenor estates, or 25% stake in effectively parts of Mount Street and Grosvenor Street in Q1. Big retail deal. But there's sort of plenty of stuff under offer that'll either happen this side or next side of Q1. So that $1 billion traded and $1 billion under offer, it's kind of quite a good start, really.
Yeah, I think you're right, Nick. I mean, again, we've been quite buoyed with 14, 15 deals. I mean, the $1 billion of deal volume we're seeing so far, that does include the JV on 2 Finsbury Avenues, which was, we think is probably $500 million plus of that quantum, but similar to the Norges piece. So, but again, real confidence from a Middle Eastern, as Modern Group, doing a joint venture with British Land and GIC, and another further over $1 billion under offer. That's not including the can of ham, which we're not sure whether it is or not, but that would be another boost, really. So quite a lot going on. I think the city is definitely starting to catch up with the West End. I think we're starting to see just processes we're involved with where there's not just the one bidder anymore, there's multiple bidders, there's a little bit more competition. It's starting to, the vendors are starting to get a little bit more of a say, I guess, in how the deal goes, because I think previously, certainly in the city, once someone gets something under offer, they're in the driving seat, I think was the perception, and I do think that is starting to change a little bit more.
Yeah. No, it's a very good point. We've got a real depth of market. Some bigger deals with a dozen or so bids on, and it definitely makes a difference. I mean, I think particularly stock where you can capitalise on some fairly quick rental growth. West End probably is predicted to be 25% over the next 5 years of rental growth for the sort of, certainly for the core stock. There's a building that's been on the market and had 2 rounds of bids. I think it's now under offer. Screen House on Wardour Street, so mid-terrace sort of Art Deco building. Tenant vacating fairly imminently, so it's being sold effectively with a very short-term income or VP, and 25,000 square feet. They weren't officially guiding, but they were talking about £1,000 a foot. So that's a building where you can probably add another floor, get up to 27,000 square feet, but it needs a full refurb, then launch to the market. So fairly quick turnaround. The agents did 80 viewings. 80
80 viewings,
80 inspections of that building with a huge, that must be approaching 50 parties. Had a dozen bids. I think it's nudging sort of 30 mil, so sort of 1,200 a foot territory. Be fascinated to see who got it, but 80 viewings on a building, 25 mil freehold, Soho. It's kind of the sweet spot for so many people. We're at the end of Q1, so I think as the year progresses, we're going to see a lot more of that and a lot of competition for buildings. I think one thing that we're lacking in the core West End is those buildings. Are there another, if 12 people, 14 people bid for it, are there another 14 buildings like that coming to market in the next few months? And the answer is probably not. So
I think also your point on, the rental growth and the end of business plan stock that we've had, certainly in the city, that's been hanging there for, 2-3 years, where parties want to crystallise a yield that makes sense and aligns with their original business plan. I think we're going to start to see a little more justification for those buildings trading now because of the rental growth forecast.
Yeah.
So, a building, for example, I'm thinking of something like a Warwick Court or something where the deals were done, possibly 3-4 years ago, are starting to look very reversionary. And I think you'll have, a number of those now where the rents, start to look, and that will impact on yields and probably allow people to realise a few more end of business plan or crystallise those end of business plans.
It seems like interest rates aren't going to do it, so it's going to be
rental growth instead.
Does it instead?
It feels like it, doesn't it? I mean, they may creep down a little bit during the course of the year, but I think we've learnt the hard way of not to put your eggs in too many baskets. But it certainly sounds like rental growth is driving, and the positivity and the interest that we're seeing on some of this investment stock may even lead to a little bit of yield tightening.
Positivity of London generally, residents consultancy voted it the number one global city again. If you look at the sort of vacancy rates in the sort of, tier one cities, whether it's New York or Paris or Berlin, Munich, etc., Frankfurt, they're all in double digit vacancy rates, whereas we aren't. And I think New York, is even much higher than, it's in the sort of teens plus. And London, you can look around, see the developments that are going on. There's some amazing schemes. I mean, recording this podcast up in King's Cross at the moment, looking out, in Granary Square, it's an amazing, and there's a lot going for London. I think we're all really positive, particularly as the sun starts shining.
Helps.
You can see investors coming over from all over. I think I said this on the last podcast. When you get Middle Eastern investors coming over, concerned that people aren't returning to the office, and you say, "Well, go and stand at Bank Station at 10 in the morning on a Tuesday, and it's heaving." And same with the West End, and booking a restaurant in an evening in the West End. It's so vibrant, and there's so much life that investors, that's why it's a kind of global market, and I think that's just going to continue. We could possibly do with some of the stock that's been marketed and maybe been not met the pricing expectations. We could do with some more of that trading. Are we going to see vendors bringing their prices down? I don't know. We're certainly not going to see interest rates moving much, so I don't know what the catalyst is going to be to get some of that stock traded, but it probably will be rental growth.
I think that's absolutely right. The rental growth will get people over the line. I think that's right. It's happening. We're seeing it. It's positive.
What else are you seeing in your world? I mean, you talk about interest rates probably not moving much. Is the positivity with the banks?
I think there was a point in time where the banks were very concerned over certain asset classes. Back in the day, retail went through the mill a bit in terms of change in shopping habits. And then the banks were very negative on retail. Similar with offices, but I think that attitude has changed. The banks are keen now to look at the right retail, look at the right offices where there's occupational demand and rental growth coming through. It's sustainable and it works, but lenders are always going to be nervous of short income streams, secondary buildings, where there's capex needed, and the demand now for reasonable levels of EPCs and sustainability. That's a concern, but then it's a concern for the investment market as a whole. Yeah. I think what we've spoken a lot about today is the best in class stock. Yeah. Which is leading the charge, and there's certainly rental growth coming through on that. The challenge will be what investors and what owners do about the secondary stock.
What is your typical multi-let leasehold or freehold in a slightly off pitch location, perhaps, where those buildings will still be difficult. I think to see some yield compression in those assets is going to take a little longer, I would have thought, and the markets will probably have to shift. It won't just be captured by rental growth. There's still a number of deals in the city that have got 7.5%, 8% in front of them, and that's to your point, Ed. They would be sort of core plus, and that core plus market has suffered so much because it's almost like you've got a very obvious value add play where you're repositioning a building to create the best in class, and then you've got your best in class, and that middle ground is very difficult to sort of realize, I think, at the moment, because your cash flow is always going to have short leases, 2 years, 3 years, and then a void, and then a
refurb costs,
fitted, Cat B potentially as well. So you never really realise that 7.5%, 8% yield, which looks very attractive on paper. It's going to be a lot lower than that. So I do think that those buildings, there's a market for those buildings. Sure, they are trading, but it's a lot more difficult.
We all know what should happen to say. Look at Hammersmith, for example. We buildings should be being converted outside the sort of core Hammersmith market on the fringe of Hammersmith. Some of those buildings should be going to residential, but the local authorities largely seem to be resisting it. We're still seeing Hammersmith occupiers, creative artists moving in from, say, Hammersmith to Bloomsbury, 85,000 square feet. We're still seeing a sort of retrenchment back to sort of core central. In Hammersmith, to my mind, a lot of that should be going to residential, but it isn't. The planning's still quite difficult. Less so in the city for C1 for serviced apartments, but
specifically in the city, Hackney, Tower Hamlets, Islington, and I guess Camden, which falls across both our markets, are still, they're not been as proactive as the city in embracing that change of use for the more difficult buildings. So it is still a challenge, definitely. And those markets you feel would benefit probably more so from having a bit more flexibility.
Yeah, there's a lot to play for, isn't there? If rental growth keeps rising in the central areas, logically it should feed through, but I think there's a long way to go before we get to that point.
Definitely.
Yeah.
Great. Well, thanks very much, Nick and Chris. Really interesting discussion this morning. I think we're feeling positive. The sun's out.
Mm-hmm.
Yeah.
Let's see how the year progresses.
It'll be really interesting if we do one of these later in the year to see where we get to volume-wise. And
are we still as optimistic?
Market-wise.
Hopefully.
Let's hope so.
Thank you, Ed.
Okay, thanks everybody.
Cheers.
Thank you.